Welcome back. I don't waste your time. Let's get straight into it. Not going to beat around the bush here. These three are the best opportunities that I've identified in the markets today. Now, in a second here, I'm going to dive into the methodology and exactly how I arrived at these numbers. But firstly, I'd like to point to the PEG ratio, which I'm sure a lot of you guys are familiar with, but for those who don't know, the PEG ratio is simply the PE ratio, which is often the most cited valuation metric ever, divided by the amount that earnings is expected to grow. So for example, if you have a company that's trading at a PE of 12 and the earnings are expected to grow at 12%, the PEG ratio would be 1. If the PE is 12 and the earnings that's expected to grow is 6%, then 12 divided by 6, you'd arrive at a PEG of 2. Now, I'd like to point to this chart from that I found from Twitter, from this gentleman right here. And this is a little bit dated. It's from December. But nonetheless, it still reveals something very interesting. This chart shows that stocks like Tesla and Amazon, based on their PE and the amount that those earnings are expected to grow at, are very similar in valuation. Now, in a second here, I'm going to dive into how free cash flow plays on that and how this is completely, it couldn't be further from the truth. But what's interesting about this is that based on the amount of earnings that both these companies are expected to have, they're probably similar in valuation, which if you go look on a website like FinChat, not sponsored by the way, I wish, but you would see that the PE on Tesla in the last 12 months is 41. And then you can go over to Amazon and you'd see that it's 61, right? You could even look on a forward basis, Amazon at a 42 and Tesla over here at a 56. So similar-ish valuations, right? But the part where it gets very revealing is the price to free cash flow, which for all intensive purposes, you could just think of free cash flow as a different type of profit. It's not exactly that, but for our sake, we'll just assume that free cash flow is just a different way of measuring the profits of the business, right? The price to free cash flow of Tesla is 125 times trailing, and it's expected to be 112 times on a forward basis in the next 12 months. If you go, again, look to Amazon, it's 30 times on a forward basis. So that means that on a forward basis, Tesla is almost four times more expensive than Amazon. Now, I saw this, and there's a lot more criminals and criminal offenders, let's say, of this very thing, whereby the free cash flow is drastically different from the net income. I believe the solar stocks are also big offenders of this. But this got me thinking, and this is the reason why I made my calculator here, is to essentially create the PEG ratio, but instead of the PE and the growth rate of the earnings, we do the free cash flow as the numerator, and then as the denominator, we do how much those free cash flows are expected to grow. So that's exactly what I did. I put three inputs, which I believe to be are the only necessary inputs for this. I put the amount of free cash flow that is estimated to be generated by these businesses in the following year. And I pulled this off of FinChat, by the way. And then I also got the amount of stock-based compensation. So if you didn't know, stock-based compensation is, especially with tech companies and software companies, it's a means of paying the employees, but not paying them with cash. So you can imagine that in a lot of software businesses, they would pay their employees with shares of the business as opposed to paying them in cash. This right here, as a percentage of how much free cash flow generated, that's how much they paid out in stock-based compensation. So you can see there's some pretty big offenders of this, like CrowdStrike, which is a cybersecurity company. Or over here, we got Tesla all the way at the bottom, 40%, again, massive offender of this very thing. And of course, we have our angel, Evolution Gaming, precisely sitting at 0%, no stock-based compensation. Third item on the list is the expected growth rate. For full transparency, I just used the expected growth rate of the EPS, expected long-term growth rate. Long-term growth rate, I believe it's the 3 to 5 year EPS growth rate averaged by all analysts. This is a flaw in my calculations, but nonetheless, I couldn't exactly find free cash flow growth rate. I looked on Seeking Alpha, I looked on a bunch of different websites, couldn't find anything. So this does assume 100% free cash flow conversion, which most of these companies are around there, but plus or minus just a little bit. But again, this does add some inaccuracy to our model. So anyways, I just pulled that data straight from FinChat, with our three inputs, I'm able to identify all these other data points here. And at the end of it all, we land at a price to free cash flow on a forward basis right here. So for example, let's just take Amazon over here, 30 times forward price to free cash flow, which again, if we refer back to FinChat, roughly in line with what it is. So roughly 30 times forward price to free cash flow. And then we simply divide that by the growth rate of the company. So in this case with Amazon, 30 times divided by 24, you land at 1.8 times free cash flow. Or sorry, my apologies. I actually take into consideration the stock-based compensation. So this right here is the stock-based comp adjusted divided by the growth rate. And again, we got the stock-based comp as a percentage back here. All in all, that's how I landed at the free cash flow numbers. And you can see, ideally we'd have this closer to 1, which is the scenario over here. Anything under 2 is probably still decent value. And that is how I came up with these three names: Evolution Gaming, Salesforce, and Amazon. What's interesting to note is CRM and Amazon both have pretty high stock-based compensation. Evolution obviously just chilling at 0%. But the bigger, more impactful item was their expected growth rates. So as you can see, as you trail down, you land at companies like LVMH and Apple down here. Even though their valuations aren't too demanding compared to, let's just say, Amazon up here, or Salesforce, even though their valuations aren't too demanding, it's the growth rate that really kills them and gets them into the red category down there. And then, of course, we have our biggest offender and the laughing stock of my analysis, Tesla, which is just on an island on its own. We should actually make this like dark red. But anyways, that's that. Moving forward, I'd like to just quickly go over a couple charts with each of these companies and just give a quick description of what they do. Evolution Gaming obviously is not the casino operator, but they make the live games for websites like stakes.com and stuff. So the live games that these companies have over here, and you could go in and play Crash or whatever. They make these live games, right, with like real people. They make the studios, and you could tune into the websites and whatever. Very interesting read. I'll link the Substack in the description. I believe he doesn't have that many viewers or subscribers or whatever, but very interesting read. I forget the name of the author, but if you're interested in this company, I'd highly recommend you read that. Long story short, this company is very dependent on scale economies. The biggest scale player in this industry is the Ultimate Winner, and from memory, I want to say they have roughly 50 to 60% market share. Very interesting company, high return metrics, very fast growing, expected to continue their fast growth, and they pay half of their profits in dividends with like a rapidly growing dividend. Anyways, this is the free cash flow chart, and yes, your eyes do not deceive you. That is a 63% compound annual growth rate on the free cash flow. Again, we don't expect this to keep up just because the starting point back here was very low, and obviously COVID boosted everything. And yeah, and then I'd like to compare this to the capital expenditures. So if you didn't know, capital expenditure simply refers to property, plant, and equipment. So buying a company truck, buying a new warehouse, buying a new building, all these different things that are like hard long-term assets, that is capital expenditure by the company. As you can see, it is increasing since 2019, but not meaningfully. So the company is able to grow outsized free cash flow while keeping their capital expenditure, which again, this is the root of the business. This is what creates all this free cash flow, is the capital expenditure. They're able to scale much faster than they are spending on capital expenditure, whereby each marginal additional dollar that's invested into business and into CapEx to create new studios and all this stuff yields them a lot more in free cash flow. Again, outlined by the chart here. Moving on, Salesforce. Salesforce, for nearly its entirety of existence, has been a story of I shouldn't say failed, but a lot of stock-based compensation. So for much of its history, about half of the free cash flow has been eaten up by the stock-based compensation. And as of the most recent quarter, they had a great quarter whereby they had a lot more free cash flow, and their stock-based compensation actually went down. So as you can see, since 2020, it's like clockwork. Stock-based compensation keeps going up higher and higher. And the reason it went down is because 3 activist investors got involved with this company, and they were kind of able to clean things up, and Salesforce was able to clean up their act. I think this is a great opportunity. I think free cash flow growth is going to continue, and stock-based compensation should realistically stabilize or even go down as it did in the most recent quarter. But yeah, long story short, I believe they're expected to do just under 12 billion in free cash flow, and that free cash flow is probably going to grow for 20% plus. Very sticky product, very promising company. I'd highly recommend you research this one further. And yeah, Amazon, my favorite. Amazon, again, similar story. Free cash flow has, for the most part, been suppressed by stock-based compensation. As you can see, even to this day, it's roughly 75%. On a going forward basis, the reason, if we go back to my calculator here, I assumed only 30% would be taken up, partly because CRM is a comparable company at 30% now, and Google, but partly because if you go back and look in previous years, between 2015 and 2020, about 25 to 35% of the free cash flow was used up by stock-based compensation. So I'm just using historical averages before the COVID period. Another interesting thing to note is in 2021 and 2022, you could see that free cash flow went down. And sorry, not down, but it was very negative. The reason being is the excessive capital expenditures by this company. You could see between 2019 and 2020, it doubled, and within another year, it nearly quadrupled, and it stayed there. So the story with Amazon for the past couple of years has been they've massively expanded their network, where it went from 2-day shipping to 1-day shipping, same-day shipping, and then at this point, they're delivering orders within a couple hours, right? So the story has just been scale, growth at all costs, and let's just forget about profits for a little bit while we absolutely just go ham on expanding the network. And that's exactly what they did in 2020, 2021, and 2022. But it looks like Andy Jassy, the CEO of the company, has really stepped off the pedal in the most recent year. And this is what's resulted in free cash flow swinging, nearly $50 billion? Just ridiculous numbers. But yeah, that's the story of Amazon. So I think this should be expected to grow, the free cash flow, of course. And I expect, and analysts would agree with me, that they will produce somewhere in the neighborhood of $60 billion of free cash flow. So you're looking at this doubling. And I, frankly, even though it did tick up year over year, I don't expect stock-based compensation to continue growing as rapidly as it has in previous years. I point to cases like Salesforce, where they've maintained stock-based compensation, and actually it went down year over year. And also there's companies like Intuit, the CEO, he signaled that overall software compensation is probably going to cool as the demand dies down for these type of roles compared to the pandemic period, where the demand for software and engineers and all that type of stuff was much higher. But yeah, that should cover everything. These are the 3 stocks that I'm looking at and I'll probably be investing. At the time of this recording, I do have shares of Evolution in Gaming and Amazon, and I'm still in the research process with Salesforce. I'm probably going to be uploading a deep dive on Salesforce and all that I've found out, just because I think there isn't a lot of great content on YouTube highlighting exactly what this company does and what the benefits are. Thank you for watching. Have a great day.